China's $200 billion gold, bet against the US dollar, somewhere in vaults few outsiders will ever see. A quiet transaction is taking place, not a headline, not a press conference, just gold moving, billions of dollars worth disappearing from the open market and into the hands of a single government. Why would the world's second largest economy quietly stockpile the one asset that has outlived every currency in human history? What does China know that most investors don't? By the end of this video, you will understand exactly what is happening and why it may already be too late to ignore it. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious viewers understand the forces quietly reshaping the global financial order long before those forces reach the evening news. If this is your first time here, consider joining the community by subscribing. This channel is built for people who prefer to understand a shift before it becomes a headline, rather than after. Decision makers, business owners, and anyone responsible for protecting what they've built. There's no pressure, only an open invitation to think ahead together. On a quiet day in August 2026, something important happened. It did not arrive with fireworks. It did not arrive with a press conference full of cameras and world leaders. It arrived buried inside a long government document, a document most people would never read. That document was China's 15th five-year plan. It covers the years 2026 to 2030. Every 5 years, the Chinese government releases a plan like this. It lays out goals for the economy, for industry, for trade, and for the country's place in the world. Most of these plans are technical. Most of them are dry. But this one contained a single line that analysts around the world had been waiting years to see. For the first time, China officially stated that it would work to internationalize its currency, the yuan, also known as the renminbi. In simple terms, this means China wants more countries, more companies, and more banks around the world to use its currency, not just for trade with China, but as a currency they trust and hold on to. This might sound small, a government saying it wants its money to be used more often. But to those who study global finance closely, this was not small at all. This was a signal that had been building for almost a decade, and one that finally became official policy. Here is why that matters. When a country writes something into a 5-year plan, it is not making a suggestion. It is not floating an idea to see how markets react. It is committing. Chinese 5-year plans function differently than typical government promises made in other parts of the world. They are directives. State-owned banks, state-owned companies, and government agencies are expected to act on them. So when this plan says the yuan will become more international, it means the machinery of one of the largest economies on Earth is now pointed in that direction on purpose with a deadline. And there was a second detail hidden inside the same set of disclosures. Alongside the currency announcement, reports confirmed that China's major state-owned financial institutions have been increasingly bullish on gold. In other words, the same government pushing to internationalize its currency has also been quietly encouraging its biggest financial players to hold more gold. These two facts are not separate stories. They are the same story, told in two parts. A country cannot simply announce that the world should trust its currency and expect that trust to appear overnight. Trust in a currency has to be built on something solid. Historically, that something has been gold. This is the heart of what is unfolding. China is not just making a policy change, it is laying the foundation for an alternative to the current global financial order, one where the US dollar has sat comfortably at the center for more than 80 years. To the average person, this may sound like distant news, something for economists and central bankers to worry about, but shifts like this rarely stay distant for long. Currency systems do not change overnight, but they also do not stay the same forever. And when a shift of this size begins, those who understand it early are often the ones best prepared for what comes next. What makes this moment different from earlier warnings and predictions is simple. This is no longer speculation. This is no longer a theory shared by a handful of analysts on the internet. This is now written policy, backed by one of the largest and most powerful economies in the world, with a clear timeline stretching to 2030. For years, some analysts speculated that China was preparing for a moment like this. They pointed to gold purchases, new trading exchanges, and quiet diplomatic deals as early evidence. Many were dismissed. Many were told nothing was really happening, that the dollar's dominance was too strong to challenge. Now, the evidence is no longer scattered or uncertain. It is official, it is documented, and it is set into motion with government backing. This is why the announcement matters so much, even though it arrived without noise. Quiet policy changes, made deep inside long documents, often carry more weight than loud declarations made on a public stage. They are not designed to grab attention. They are designed to be executed. And execution is exactly what appears to be happening now. To understand why this shift threatens the dollar's position, it helps to look back at how the dollar earned that position in the first place, and why the very system built to make it dominant may now be the same system creating room for gold, once again, to rise. To understand why gold is suddenly back in the conversation, it helps to ask a simple question first. Why does the US dollar sit at the center of the world's financial system in the first place? Most people have never really asked this, they just accept it as a fact of life, the same way they accept that the sun rises in the east. But it was not always this way, and understanding how it started helps explain why it might not last forever. The story goes back to the early 20th century. During the First World War, many nations were desperate for supplies, weapons, and goods. The United States, sitting safely across the ocean, sold enormous amounts of these goods to the warring countries. In return, it received payment in gold. By the time the war ended, the United States held a huge share of the world's gold reserves. Then came the Second World War, and the same pattern repeated. Once again, the United States supplied much of the world, and once again, gold flowed into American vaults. By the end of that war, the United States controlled roughly 2/3 of all the gold on Earth. No other nation came close. This gave America enormous power. In 1944, representatives from allied nations met in a small town called Bretton Woods to design a new global financial system. Because the United States held so much gold, it made sense to build the new system around the dollar. Other currencies would be tied to the dollar, and the dollar itself would be tied to gold at a fixed rate. The world agreed to trust the dollar because the dollar was backed by something real. That system did not last forever. In 1971, the United States broke the link between the dollar and gold. From that point on, the dollar was no longer backed by a physical asset. It was backed by something less solid, but still powerful. Trust. Trust in the U.S. economy. Trust in U.S. institutions. Trust that other countries would keep using dollars for trade, for savings, and for reserves. For decades, that trust held strong. Oil, one of the most important goods in the world, was priced and sold in dollars. This created constant built-in demand for the currency. Every country that needed oil needed dollars first. This arrangement, often called the petrodollar system, cemented the dollar's role at the center of global finance for another 50 years. Being at the center of this system gave the United States real advantages. It could borrow money more cheaply than other nations because the whole world wanted to hold dollars in dollar-based debt. It could run large deficits for long periods without facing the kind of punishment smaller economies would face for doing the same thing. Some economists have called this an exceptional privilege, one earned simply by sitting at the center of world trade. But privileges built on trust carry a hidden risk. Trust is not a law of physics. It is a belief held by millions of people and institutions around the world that the dollar will keep its value and keep its usefulness. And beliefs, unlike laws of physics, can shift. This is where the story becomes important for today. For the dollar to lose its position, the world does not need a dramatic collapse or sudden announcement. It only needs alternatives to slowly become more attractive, more available, and more trusted. It needs other countries to quietly begin building systems that do not depend on the dollar at every step. This is exactly what China has spent years preparing, not through public declarations, but through steady, patient construction of new financial infrastructure, new ways to trade currencies directly with trading partners, new exchanges, new agreements, and running quietly underneath all of it, a steady accumulation of gold. The dollar's dominance was built on gold once, decades ago, before trust alone took over. Now, as questions about that trust begin to grow louder, gold is reappearing in the story, this time as part of a challenge rather than a foundation. To understand how serious that challenge has become, it helps to look at exactly what China has already built, quietly, behind the scenes, long before this announcement ever became official policy. Big shifts in global finance rarely start with a single announcement. They start years earlier, in small, unnoticed steps that only make sense once looked at together. China's move toward a gold-backed, internationalized currency is a perfect example of this pattern. By the time the world finally noticed the headline, the groundwork had already been under construction for almost a decade. One of the earliest pieces of this puzzle was the Shanghai Gold Exchange. Opened to foreign institutions years ago, it gave international banks and investors a way to trade gold priced in yuan rather than dollars. At first, activity was limited. Many analysts brushed it aside as a minor experiment, unlikely to matter much on the world stage. But small experiments, when backed by a government with a long time horizon, often turn into something larger. Over time, attention shifted toward Hong Kong, which became a central hub for precious metals, trading connected to mainland China. This was not an accident. Hong Kong offered international investors a familiar, trusted environment, while still connecting them directly into China's financial system. Building this kind of hub takes years of planning, regulation, and trust building. It is not something a country does on a whim. It is something a country does when it is preparing for a future role it intends to play. At the same time, China was not acting alone. Central banks in several other nations began quietly increasing their own gold reserves. Russia, Poland, several countries across the global south. Each added gold to their reserves steadily, year after year, without much public explanation. When one central bank buys gold, it can be viewed as routine. When many central banks, across different regions, follow the same pattern for years in a row, it starts to look like coordination, or at least like shared thinking about where the financial world is heading. This buying was not driven by short-term speculation. Central banks do not typically buy assets, hoping for a quick profit. They buy assets they believe will hold value over decades through wars, recessions, and political change. Gold has served that role for thousands of years. Unlike a currency issued by a single government, gold cannot be printed, cannot be frozen by sanctions, and cannot lose its value through a single political decision. For nations wary of relying too heavily on the dollar, gold offered a kind of insurance policy. Then came another important piece of the story, one that received far less attention than it deserved. A major European bank agreed to become one of the first clearing banks for yuan transactions in Europe. Clearing banks play a quiet but essential role in global finance. They allow transactions in a certain currency to move smoothly and reliably between institutions. When a respected European financial institution agrees to handle yuan clearing, it sends a signal to the rest of the world. This currency is becoming reliable enough and important enough to build permanent infrastructure around. None of these individual steps on their own seem dramatic. A gold exchange here, a trading hub there, a handful of central banks quietly buying gold, a European bank agreeing to clear a foreign currency. Taken one at a time, each event could be dismissed as routine business. But infrastructure like this is never built for a single afternoon of use. It is built to last for decades. And once it exists, it tends to attract more activity, more trust, and more users over time. In the same way, a new highway attracts new traffic once it is finally finished. This is the key lesson hidden inside part 3 of this story. The recent announcement inside China's 5-year plan was not the beginning of this process. It was closer to the final piece of a puzzle that had already been mostly assembled. The exchanges were built. The trading hubs were open. The gold reserves had been growing for years. The clearing relationships were forming. All that remained was for China to state clearly and officially what its long-term intentions actually were. That is exactly what happened in August 2026. Understanding this timeline changes how the announcement should be viewed. It was not a sudden shock. It was the final, formal confirmation of a plan that had been under construction for a very long time, built piece by piece, largely out of public view. The next question is the one that matters most for anyone trying to understand where this leads. If the visible number tied to this shift is already measured in the hundreds of billions of dollars, what does that number really represent? And more importantly, what does it suggest about the scale of what remains unseen? When people hear a figure like $200 billion, it can feel like the whole story. A large number clearly stated, easy to remember. But in global finance, the numbers that get published are often only part of the picture. The real total is usually larger and often much harder to measure. There are several reasons for this. Central banks do not always report their gold purchases right away. Some purchases are disclosed months later. Some are reported in smaller batches to avoid drawing too much attention at once. Other purchases move through indirect channels, using intermediaries or state-linked institutions that are not always required to report activity in the same way a central bank is. By the time the public sees a number like $200 billion, more gold may have already moved than anyone outside a small circle of officials truly knows. This is not necessarily about secrecy for its own sake. It is simply how large, careful buyers tend to behave. A government does not want to announce in advance exactly how much gold it intends to buy. Doing so could drive prices higher before the buying is complete, making the strategy more expensive. So the true scale of accumulation often becomes clear only in hindsight, once enough time has passed to piece the full picture together. This raises an important question. If $200 billion is the number the world can see, what does that suggest about the size of the effort as a whole? To answer that, it helps to think about why gold matters so much to this specific strategy. A currency cannot simply declare itself trustworthy. Trust has to be earned, and historically, it has been earned by tying a currency to something real, something that cannot be created out of thin air by any single government. For most of modern history, that something has been gold. It has no political allegiance. It cannot be sanctioned. It does not depend on the promises of any single leader or institution. This is exactly why gold remains attractive to a country trying to build international confidence in its currency from the ground up. If China wants the yuan to be trusted the way the dollar has been trusted for the past 80 years, gold becomes a natural and necessary part of that foundation. Not because gold will formally back the yuan the way it once backed the dollar under Bretton Woods, but because large gold reserves give a currency credibility, weight, and a sense of long-term stability in the eyes of other nations. This has consequences that reach far beyond China's own borders. As more global trade begins to settle in yuan rather than dollars, demand for dollars could gradually soften. A weaker demand for a currency tends to reduce its value over time. For countries and businesses that rely heavily on the dollar, the shift could show up as rising prices, more expensive imports, and pressure on savings that are held mostly in dollar-based assets. This is not a story about sudden collapse. Nothing about this shift suggests panic or immediate crisis. Instead, it describes a slow, steady repositioning, one that has already been unfolding for years and is now expected to continue, deliberately through 2030 and likely beyond. 5-year plans, by their nature, are built for patience, not speed. Still, patience does not mean the changes are small. Slow shifts, if they continue long enough, eventually reach a tipping point where their effects become impossible to ignore. Inflation that once seemed temporary can start to feel permanent. Currency advantages that once seemed guaranteed can quietly erode. And by the time these effects are visible to the average person, the underlying shift has often been building for years already, much like it has been here. This is why the $200 billion figure should not be viewed as the full story. It should be viewed as a visible marker, a single data point confirming a much larger, much longer process already in motion. The final part of this story turns to what this shift may mean, not for governments or institutions, but for individuals watching this unfold from the outside, trying to understand how to think about their own financial future in a world where the rules may be changing.